Hello and welcome. You're watching KYC, Know Your Company. Today, we're going to focus in on Hariom Pipes. Company, as the name suggests, is a manufacturer of high-quality steel products, vertically integrated steel manufacturer with 800 plus SKUs, does all kinds of products from pipes to scaffolding, all of it. And one of the few players to have end-to-end backward integration. That's where the company really is able to stand out versus peers. Now, in terms of where it makes its money from, 92% of the revenue share comes from value-added products. This is in FY24, and it was 80% in FY23. So it's gotten better in terms of the value-added products that it does as part of the total revenue of the company. 37% of revenues come from MS tubes, 53% from GP and CR pipe and coil. These are different products that the company manufactures, and around 2.5% from scaffolding, which is typically what you use when you're repairing or constructing buildings. You have those large, the bamboos which hold people together while they're painting buildings. So that's how essentially the breakup with regard to revenue share is. But let's talk about the metrics. Let's break those down, and I'm going to talk about performance parameters first. The performance parameters that we're going to analyze for this company: income statement, balance sheet. Then we're going to look at sales volume. Critical because it's into steel and steel associated products, and therefore where does sales volume go will be very, very important. Plus, as you now well know, they're doing more of value added products, and therefore an added volume will always enhance both the top line as well as the margin number. Both of those will likely improve. Let's move on. You also have the cash flow, which we'll look at, but we'll look at return ratios. We'll also look at shareholding, street cred, and street coverage. Those are our 8 parameters that we will look at for this company. Let me bring on board Mihika, who tracks the sector, of course, closely, and I'll allow you, Mihika, to take over with regard to the income statement.
Yeah, let's start with the income statement check. FY24 revenues to the tune of 1150 crores, EBITDA at 139 crores, and net profit at around 57 crores. And when you look at the 3-year compounded annual growth rate, it remains healthy. Revenues have grown at a 64% CAGR, EBITDA to 57% CAGR, net profit at a 33% CAGR. So it's a thumbs up on this one. Although in the 3-year time period from FY22 to FY24, margins have declined 100 basis points and averaged around 12.7% in FY24. They have improved so far in FY25. They stood at 13.5% in the second quarter of FY25. So it's a thumbs up in terms of your income statement check, Harsh. But how does the balance sheet look like?
Well, the balance sheet has had its fair share of concerns, and I'll try to break those concerns the best I can. First off, your equity shareholders funds currently sitting at 550 crore. Mind you, this is roughly a 1650 crore kind of market cap company, and 550 crore of that is equity shareholders funds. They've done a fundraise as well recently, so that's something to keep in mind. But let's look at the debt numbers, and this is where some bit of skepticism starts to creep in. So you've got borrowing of 106.5 crore, but within the current liabilities section of the balance sheet, you have short-term borrowings of 228 crore. Now, Mika, this is after repayments that have been made. Around 70 to 80 odd crore have been repaid both in long-term as well as short-term borrowing. And the company has also had a fundraise. And therefore, there's been an equity raise to repay some of these borrowings. But nonetheless, the borrowing number on the short-term is far larger than the long-term. And then let's look at cash balance. Now, you would expect a company like this to have a larger cash balance, but currently just sitting on 2.5 crore rupees of cash at the moment. And therefore, balance sheet a solid neutral at best, because you are seeing that it's not the healthiest of balance sheets. No major concern at the moment because cash flows are taking care of it, but not the best, Mihika.
So a neutral on that one, but when you talk about your sales volumes, they've remained healthy. Now, if you break it down from FY20, you can clearly see the kind of growth. FY20 around 44,888 tons, but FY24 was 1.9 lakh tons, and that was almost an 80% year-on-year growth. So, if you talk about the 5-year compounded annual growth rate, it's at a 45%, which is pretty good. Even if you look at your Q2 FY25 numbers, there was an 11% year-on-year growth to around 56,000 metric tons. So that's a strong point and a thumbs up in terms of the sales volumes, because they have been increasing consistently for the last 5 years. But Harsh, in terms of your cash flows, how are they looking like?
Yeah, let's look at it. Let's zoom in on it, because again, cash flow is not looking the healthiest in that sense. When you're looking at cash flow from operations, FY22 was 4 crore, declined to a negative 101 crore, largely because of a larger trade receivables as well as more inventory build-up in that year. Thereafter, it's come back to the normalized 5 crore number. So no major increase that we can see on the cash flow from operations. The net cash flow too, slightly different, because in FY24 they've made some investments because they've turned cash flow, operating cash flow positive. They've made some investments in fixed assets, due to which you are seeing that negative 102 crore number. But more importantly, I'd want to see the cash flow from operations continue to spike up in case of a fast growing company, which it has been, frankly. 3-year 64% revenue CAGR, but cash flow has some work to do, and therefore we're going to rate this not the best in that sense. Cash flow, that metric doesn't really stand out, Mihika.
On the return ratios also, it's been a slight decline in terms of what you've been seeing. 2023, your return on equity and return on capital employed remained healthy, 19%, 17%. But since then, 2024, we did see a dip, like you can see on your screens right there. 2024, 13% return on equity, ROC is at 15%. And if you look at the last 12 months, a return on equity has kind of inched down to 12.53%, but that's taken into consideration 6 months of FY24. But when you look at the return of capital employed, that there is an improvement there, 16.62%. We're giving it a thumbs down on this one simply because you've not seen that improvement, but it'll be key to see how it turns out for your entire FY25. But in terms of shareholding, which is what I want to talk about next, it's a good picture from their promoters, have a significant over 50% shareholding that's been maintained at 15.16. FIIs, when you look at September to June, they have inched down, but that was a period when we saw heavy sell-off in the markets altogether. But your domestic institutional investors have picked up stake. It's minor, but there is an increase when you look at from a quarter-on-quarter period. It's at 0.38% versus 0.16%. In terms of your others, which also includes your retail investors, there is interest there, a strong 32%, and that's only inched up when you look at a quarter-on-quarter. So it's a thumbs up on this parameter. But lastly, Harsh, when you talk about the street credibility or your coverage, how does that, line up?
Well, it's given a negative 16% return over the last year or so, Mihika. So clearly not the best in terms of the way this has played out. It's doubled over the last 5 years. And of course, 5 years at this point, markets were at a high and just gearing up for that correction with regard to COVID. But nonetheless, it's just about doubled in the last 5 years. The negative 16% 1-year return is what would, in some form or shape, impact the way I look at this from a street cred perspective. Now, if I were to just break this up a little bit more, the 1-month return is negative 10%. The 6-month return is negative 12%. And you're looking at a 1-year return of negative 16.5 odd. So not the best in that sense across the board when you're looking at it. So street cred, definitely a neutralish kind of view with regard to this one. But if I can also try and cover the street coverage, which is, let's look at consensus ratings. Only one analyst tracking the stock, right? It's a small brokerage house tracking it, and therefore no real clarity on how the street views this. Also, not enough people tracking it, and therefore not sure as to how questions to management is posed and how governance is looked at. and therefore it's a thumbs down on this front as well. Of course, not in the company's control, but it obviously doesn't augur well from an analyst perspective, Mika. But let's try and break down the SWOT on this one because it's an interesting one. Why don't you take over strengths and weaknesses?
Yeah. We'll talk about the strengths and weaknesses first. Multiple things working in favor for Hariom Pipes for sure. They have a diversified range of product basket, over 7 different, kind of particulars that they put in their investor presentation. And the rise of value-added products is only been increasing, which is a good thing for them. It's vertically integrated, so they have kind of a control on how their costs play out, and you can see those efficiencies coming in on how we've seen their margins perform. And this last part is the sales volume CAGR. It's seen a 45% CAGR. It continues to increase, and that works very well for the company.
Just want to add a couple of points here. So one strength that I would look at in this company is also that, one, they have backward integration.
Yeah.
So the raw material price impact doesn't flow through on the company, and they can actually price their products competitively and take advantage of raw material prices.
They have that supplier control in that sense.
Correct. And just the increase, Mihika, with regard to value-added products which they're doing as a share of the revenue, which we spoke about at the start.
Just a few years ago, it's 53%. Now it's over 90%. And that's something that they've been focusing on. It's in their strategy, and clearly it's been playing out very well for them. So in terms of strengths, they have quite a lot of working for it. Backward integration is something many of the companies in the field are still working on. But they've already done so, and they're one of the few players to do so. But in terms of weaknesses, there are certain things that could play a part. What could that be?
Well, commodity prices for one. If those come off, then you will start to see margins hurting, even though they're not reliant on purchasing commodity from outside. But the premium that they command will definitely come off in terms of margins. There's plenty of competition in the space, of course, and the geographical reach that they have is far more limited. It's a smaller company in that sense, and therefore some of those turn out to be weaknesses. The balance sheet also isn't the most robust compared to some of its competitors and peers.
But that's when you talk about your geographical reach, that's where they're working on it. They are evaluating different, in terms of, right now it's very concentrated to southern markets, but they are expanding towards Gujarat and evaluating other opportunities as well. So that's an opportunity in terms of kind of mitigating that risk of having a concentrated geographical reach. And they're also kind of getting into specialized steel. Kind of evaluating those opportunities, and it's key to note that there's a PLI incentive scheme that has just come forward from the Ministry of Steel for specialized steel. So that the country as a whole is focusing on make your own specialized steel in India, and that provides them with an opportunity, and if they apply, that could also give them incentives coming those ways. Lastly is threats. Fairly macroeconomical in the sense, Harsh, economic slowdown and tech disruptions that could kind of hurt the steel demand, and if you could see a fall in steel prices, it kind of affects how they price their products. But then it also goes back to how their sales are doing well at a lower price range, then your overall realizations still remain healthy. So there's always a counter to that threat as well.
Yeah, so but we've tried to break it the best we can, and I think we've done a decentish job in trying to do that. Let's focus in on the rating now. Let's try and pull up all that we've discussed. Income statement, check. Balance sheet, neutral. Sales volume, definitely a plus. That's the one big plus that stood out for me in terms of this company. Cash flows, negative because of the way in which they've moved versus the sales, just not picking up. Return ratios sitting in the minus as well, because we've seen return ratios actually fall on the ROE front. The ROC has been healthy, but the ROE has fallen, likely also because of the amount of working capital that they've been needing or requiring over the last 2 years. It's gone up significantly, and that's probably why those return ratios have fallen. Shareholding is a thumbs up. Street cred is a neutral. This is, of course, because returns have not been commensurate, negative 16% over the last year, and across time periods not been good. And then you have street coverage, which frankly is far and few, which is why we've given it a thumbs down on that one. That's the rating which we've given for Hariom Pipes, getting a 4 out of 8. But let's shift focus. hear straight from the management themselves. My colleague Hiral earlier spoke to the Managing Director Rupesh Kumar Gupta about the company's growth outlook ahead. Here's what they had to say.
Currently, our installed and gross capacity stands at 0.7 million tons, with an input capacity of 0.44 million tons by the end of FY25. We aim to enhance our capacity to 0.78 million tons, with a corresponding final output of 0.52 million tons. Our primary focus is to achieve optimal utilization of this capacity by the end of calendar year 26. Looking at Hariom plans to expand its capacity in specialized steel products through brownfield or greenfield projects. This expansion will strategically target locations near raw material sources and major consumer hubs across India.
Okay, and how much will it translate to in terms of sales and revenues?
In sales and revenues part, basically cash conversion and what you call the tandem mill edge and the production is again a different part overall, improving our cash flows and cycles. So we have delivered strong financial improvements, enhancing things over the past 2 years. We have reduced our working capital cycle from 175 days to 119 days in H1 FY25 and improved ROCE to 19.7% from 18.9%.
Okay, no, so then say by FY27, when you have the new capacity that comes on stream, how much revenue are you expecting to generate with 100% capacity utilization?
So the revenue generation into it will be around 3,008.38 things. So the revenue generation will be at that level.
Okay, and in terms of the different segments of business, which are the ones that will drive this kind of revenue? Which segments will be the growth drivers?
So the value-added products of our products, which are there, will be the value-added products, and those will be the betterment for the industries of us, wherein the manufacturing products such as machinery components, packing strips, pre-engineered buildings, fan industry materials, bus bodies, and automobile sector would be the major one.
Okay. And
we take the pride of adding on the tandem mill. It's a state-of-art tandem mill and a reversible mill which we have, allowing us to produce a wide range of high-quality products tailored to various market segments.
Okay. Rupesh, you mentioned about galvanized product sales as well. What is the ramp-up plan there, and what's the kind of revenue contribution that it gives you right now versus 3 years from now?
So over the past 9 months, we have achieved a year-on-year incremental volume growth of capacity approximately 38% in galvanized product sales, despite a soft market environment characterized by subdued demand and lower realization prices, recognizing the potential for further growth. We have begun producing specialized cold-rolled and galvanized coils, in addition to our regular consumer-oriented galvanized pipes, targeting high-value segments such as engineering, automobile, packaging, and electrical industries. So this strategic shift is expected to drive an acceleration in sales volume, enhance our value realization, and improve margins. And we are very much confident on scaling the production of these specialized products to represent up to 55% tentatively on our total production capacity in the coming financial year.
Okay. And Rupesh, you also mentioned about the tandem mill. Now, that is with regards to production of sub 2 mm pipes, if I'm not mistaken. How does that become a true differentiator for your company?
Yeah, so the key distinction between a tandem mill and a general reversible cold mill lies in their approach to reducing coil thickness. Tandem mills achieve this in a single pass as opposed to multiple passes, enabling more precise control over the mechanical and chemical properties of the output material. The precision of is essential for manufacturing diverse products such as machinery components, packing strips, pre-engineered building products, fan industry products, bus bodies products, and automobile sector products.
Okay. And
In this basically we take a pride in operating both the state-of-art tandem mill and reversible cold mill, allowing us to produce a wide range of high-quality products tailored to various market segments. This strategy capacity positions us strongly for sustainable growth and competitiveness in the market, enhancing share value of the long term for the share value holders.
okay, so taking all of this into consideration with regards to your value-added products and the capacity addition that you're seeing, how are you looking to fund it? Is it going to be completely through internal accruals?
Yeah, so the company is not having any plans for taking the debts now. It will be with the internal accruals only.
Okay. And apart from that, the cash conversion cycle has been slightly skewed, right? What are the plans with regards to actively improving it, and where do you see it from here on?
So basically, we have achieved a remarkable turnaround in operating cash flows, generating around 50 to 52 crores in H1 FY25, a 185 or 187% growth from H1 FY24. We are confident in sustaining this growth trajectory for a long-term shareholder returns.
Okay. And with regards to where the backward integration is concerned, right?
Yeah.
All of this taking into consideration, how will it actually aid your margin profile from here on?
When we are discussing on MS pipes and tubes and the backward integration, it is important to highlight that this product stands out as our USP in terms of margins, surpassing all other offerings. The key reason behind this is our fully integrated production process, which transforms iron ore into MS tube seamlessly. Additionally, our ability to produce thinner thicknesses of MS tubes using our in-house HRM sets us apart. As such, production is either unfeasible or highly challenging through the traditional blast furnace route. In the segment of thinner MS tubes, we face no significant competition for sustainability. Despite the steel sector's expanded capacity over the past 2 years, over the last 3 fiscals, this segment has delivered an impressive EBITDA of 15.4%. Moving forward, we remain focused on driving both volume and margin growth in this potential segment, positioning it as a key driver.
Okay. So Rupesh, between MS pipes and tubes and galvanized products, let's talk about these two segments. Which of the ones are you betting big on?
So MS pipes and tubes obviously would be our USP, and adding on to the galvanized products, as we are entering into the coil segment and value-added products, that will enhance. So
Okay.
it is a process which is going on, and we are tying up with multiple OEMs and other manufacturers who are adding on the values to the consumer base.
And with regards to galvanized products as well, you've made the foray, your ramp up is underway. You have your tandem mill advantage coming in at that level.
Yeah.
How are HRC prices then panning out and impacting that part of the business?
So part of 2 quarters have been weaker in terms of the government spendings and other things, as well as the prices have been dropped down. In that particular segment, in this whole of this segment, we can see there is a little bit of drop down, but again, we are doing better as our backward integration is supporting us a lot, and we are good at that particular point.
Okay. And with regards to where the scaffolding segment goes, you have been seeing some bit of pressure there. What is the outlook looking like from here on?
So in this particular segment, as we are there in Telangana now, and the government has been changed, and there are a few policies have to be implemented. In the construction field, we are facing little of problems as expansions in the infra and other things are not going on. Hence, this quarter was little weak, but still not that weak. But
Well, we're out of time on this edition of KYC. From Mihika, myself, everyone who puts the show together, thanks so much for watching. Hope this was extremely helpful. That's the rating on Hariom Pipes as well. But thanks so much for tuning in. More on the other side. Stay tuned to NDTV Profit.